Let's continue about the overview of financial regulation. So here's the definition. Rules and guidelines set by regulatory bodies to ensure transparency, fairness, and accountability in financial management. K. Regulatory bodies. Securities and Exchange Commission oversees securities markets and protects investors. Financial Industry Regulatory Authority regulates brokerage firms and their registered representatives. Federal Reserve regulates banks and implements monetary policy. European Securities and Market Authority regulates financial markets in the EU. Key regulations: Sarbanes-Oxley Act enhances financial disclosures and corporate governance. Dodd-Frank Act regulates financial institutions and protect consumers. General Data Protection Regulation protects personal data privacy.
Good day everyone, my name is Jason Teobordo and this is my assigned topic is to discuss the impact of regulatory changes on businesses, outlining the key areas of influence, challenges, and opportunities that arise from such changes. Changes in regulations, interest compliance costs. New regulatory often required businesses to invest more resources to ensure they are following legal requirements. They could involve hiring additional staff, updating system, or investing in new techniques to manage compliance. Next is operational adjustment. Company may need to alter their internal processes, policy, or procedures to align with the new regulations. This can be affect now.
Good day everyone, I am Maya Antivo and I am reporting about the ethical dilemmas in financial management. So, ethical dilemmas in financial management, these are situations where financial decisions create a conflict between doing the right thing and meeting business goals. So, there are three common problems of ethical dilemmas in financial management. First, conflict of interest. Like for example, a manager hires their friend for a job even though there is someone else is more qualified. Number 2, insider trading. Like for example, an employee buys company shares because they know share secret news that will raise the price. Number 3, changing financial reports. Like for example, a company lies about their income to make it look like they are doing better than they really are. So, how to decide what is right? Be honest. Follow rules and responsibilities and make fair decisions for everyone.
Case study number 1. Enron Scandal Overview. Enron, a once powerful energy company, engaged in fraudulent accounting and misinterpretation. The company use of balance sheet entities to hide debt and lack transparency and integrity in its financial reporting. This deception led to significant financial losses for employees, investor, and creditor. There are two types of issue. First is financial manipulating Enron. Use of balance sheet entities to conceal definting to misleading pictures of its financial health. And second, ethical breaches. The company lacked transparency and integrity in its financial reporting, deceiving investor and stakeholders. Outcome: bankruptcy. Enron filed for bankruptcy, causing significant financial losses for its employees and investor and creditor. Next is legal consequences. Numerous individuals involving in scandal face legal charges and imprisonment. First, regulatory change. The scandal led to enactment of the Sarbanes-Oxley Act, SOX, SOX, which impose stricter regulation on corporate accounting practice and financial reporting. That's all. Thank you.
Case Study 2: Volkswagen Emission Scandal at the Trial of Trust. Overview: Volkswagen used software to cheat emission tests, allowing their diesel cars to emit significantly higher level of pollutants than legal limits. Issues: Regulatory violations. The company violated environmental regulations in multiple jurisdictions. Second, ethical breaches. Volkswagen knowingly deceived consumers, regulators, and the public about the environmental impact of their vehicles. Outcome: First, legal penalties. The company faced billions of dollars in fines and legal settlements. Second, reputation damage. Volkswagen reputation was severely damaged, leading to a decline in sales and consumer trust. Third, regulatory reforms. The scandal prompted stricter emissions regulations worldwide. Case Study 3: Wells Fargo Fake Accounts Scandal. Overview: In 2016, Wells Fargo, a major U.S. bank, was embroiled in a scandal involving the creation of millions of unauthorized bank and credit card accounts. Bank employees were pressured to meet aggressive sales targets, leading them to open accounts without customers' knowledge or consent. Issues: Fraudulent practices. The unauthorized creation of accounts constituted fraud. Second, ethical breaches. The pressure on employees to meet sales targets to lead unethical behaviors and damage the bank's reputations. Outcome: First, fines and legal actions. Wells Fargo faced significant fines and legal actions from regulations. Second, increased scrutiny. The scandal led to increased scrutiny of sales practices in the banking industry. Third, damage to reputations. The bank's reputation was severely tarnished, impacting the customer trust and business. Highlights. So, the scandal highlights the importance of ethical business practice and the dangers of a toxic corporate culture that prioritizes short-term gains over long-term integrity.